Ghana is ending 2025 as Africa's fourth largest IMF borrower, underscoring how external support has become a key pillar of economic management. While IMF backing has helped stabilize the cedis, rein in inflation, and restore a measure of investor confidence, the growing debt footprint highlights the trade-off beneath the relief. It sharpens questions around policy autonomy, fiscal discipline, and the pace at which the economy can generate enough revenue and growth to sustainably reduce its reliance on external lifelines. International financial analyst and investment consultant Patrick Baah Abankwa joins us now from Ghana on this discussion. Thank you for your time and compliments of the season to you.
Thank you.
Right. So, Ghana is ending 2025 as Africa's fourth largest IMF borrower. So, I mean, it places Ghana high on the continent's debt league table. Beyond the ranking itself, what does this mean?
Thank you very much. I think that the ranking by itself, for me, I see it as just like a headline. But the real story behind the headline is where I want us to focus on, which is where we were and where we are going to, which is the trajectory. Yes, we owe a lot of money to the IMF, as you rightly said, but the debt for me is still cheaper than the Eurobonds that nearly crashed the country about 3 years ago. The economy is, for me, showing some kind of resilience for the last 2 years, not because we borrowed more, but because we are finally treating the underlying illness or the sickness that we're going through, which is more like dealing with the issues of inflation. As we speak at the moment, inflation has dropped to single digits, and our reserves are rebuilding as a country. I would say that we are still in the healing process, but we are still a long way to go in the recovery stage of the country. I think that gradually we are getting to a stable environment, but not as strong enough to begin to run as a country. So I'm looking at it not just on the headline basis, but also the story behind the headline, which is where we were before the IMF situation, the last one that we went, and where we want to go to as a country.
And I think the question would be, how did Ghana find its way from where they were to where they are? What was key in buoying that recovery?
So, anytime IMF comes into countries' affairs, usually there are certain conditions that the country will have to meet. For Ghana, majority of the conditions have to do with restructuring of our external debt, including even those locally, which is the domestic debt. So in 2022, when government had to go to IMF for the external credit facility, IMF made very clear that we were not sustainable when it comes to our debt situation. So we needed to restructure first the local debt, where government had to restructure the local bond, and then went into the external debt, where we needed to also restructure that. That step alone was able to give the country a space in terms of what pressure we were going through on our balance sheet, and that gave government the space to be able to put some of the debt into the future. That was the first step. The second step was the issue of financial and fiscal discipline. Anytime IMF comes into your books, they don't just give you funds. They give you funds with some conditions that you need to meet. And that has helped the country to stabilize with time, because that's drawn a bit of investor confidence into the country once again. Investors that were withdrawing their funds because Ghana was tagged as a junk nature when it comes to investment, were now confident to bring their monies back. And that also boosts the economy and made the economy a bit stronger, with the fact also that there was a change of government beginning of the year, and that also brings some kind of confidence into the country. So all of these things are part of the IMF program that, for me, has helped us to get to the point that we are at the moment.
Yeah, and as you have pointed out, the numbers are looking good. IMF programs, as you've said, typically they come with fiscal targets, reform benchmarks, but one begins to wonder the trade-off here. So with borrowing at this scale, how much real policy space does the government still have to prioritize domestic spending needs?
I think that, yes, there are some conditions that these arrangements come with. Government will always have to look at it from the broader perspective to say that, okay, these are the conditions that we are going to face ourselves with, but what is the trade-off for us as a country? We cannot continue to do the things that we do every day and expect that if IMF comes into our books, things will begin to be the same. They always come with its own policy. So it means that government will have to now look at how to streamline and focus on the projects that are of importance and not to be doing what they were doing all the way before IMF came into being. So it means that government cannot be engaging in every kind of project as it used to do. Government will now have to look at ways to expand the tax-based system so that it will be able to get more to do local infrastructure projects, at the same time looking at how it can raise funds locally to be able to undertake statutory payment and statutory obligations. So I think that that's what the condition has come with and what government has tried to do for the first year, which is 2025. And we hope that as we go into the year 2026, some of these things will be able to notch up because of the policies. Usually when you bring out a policy with a new government, it takes maybe a year or two for it to begin to take shape, and that's expected as we go into the year 2026. But of course, government cannot or is not in the position to continue to do the expansion that he was doing, because some of these expansions were born out of the Eurobond market that went into excessive borrowing from the local market. And these are the conditions that led us to go back to the IMF in terms of the external credit facility arrangement that we are currently experiencing.
And do these conditions, do they serve Ghana's short-term or long-term interests?
I think that in the interim, this is one that was necessary because we got to a point where confidence from investors were not there. Ghana was shut out of the Eurobond markets early part of 2022. It means that there was always a shortfall in our budget that now there was no way that we're going to raise money outside Ghana to be able to balance off that particular point. So IMF coming in place meant that, investors were now having confidence that, okay, let's bring back our funds into the country, because IMF is the, in quotes, the security man that is watching to ensure that our interest is there. But for me, the concerns of these investors is not just now, because they know that IMF, once they are there for 3 years, things are going to be better. The concern, which is the long term, is that if IMF is no more there, is the country still going to be disciplined enough, stay true to the conditions that they were going under IMF, or they'll go back to the excessive borrowing, which will mean that their funds that hitherto were assured because of IMF commitment will now not be there. So in the interim, it's a very good way to give the country some good name, some confidence again. But in the long term, that's where we need to be able to change the narrative as a country, not to go back to the same excessive borrowing, which led us to the challenges that we face post 2022, where we needed to now go back to IMF for the 19th time as a country, which is not a very good story.
So no doubt Ghana's current IMF program has helped ease liquidity pressures, stabilize key indicators, as you have pointed out, but there are also those that will say that it's mainly just buying time. So, do you agree with that, or is it genuinely forcing the country to confront some of its deeper structural weaknesses?
I think that's it's an issue of buying time for me, because as I said, if you have gone to a borrower or a support system for the 19th time, I'm not sure that if you had done your things right, you would have gone to the 19th time. It means that there should be a change after this one. And the change is the fact that we need to now look at how we can mobilize internal funds, local funds, to be able to meet up our obligations that we see as a shortfall from our monthly or yearly budget that the government brings up every year. So that's the first thing. The second thing the government will also have to look at is the fact that when it comes to certain exemptions, as a country, we lose billions every year to tax holidays that companies do not actually need them. And that's also one of the ways that we are losing out money as a country. So that can also be looked at as a major point going into the future, because if you're able to get those billions of Ghana cedis, which we are giving to companies as tax holidays, into our books, it means that our revenue base is going to grow faster than we are seeing. Then the third one for me is also the issue of how much money we spend or we lose in our energy sector. We cannot continue to be losing money in the energy sector by paying money to companies for power that we don't need. That debt is a very big hole. If you look at the IMF program, look at the debt structure of the country, that was a major factor where we were paying people are producing power to us for no work done. And that is something that we should be able to plug out as part of the IMF program. Beyond that, we shouldn't get back to that point again. We should also look at how we can formalize our informal sector when it comes to our tax base. Once we are able to rope them in, things will begin to look better for us beyond the IMF program.
All right, Patrick, and thank you for your thoughts there. Do stay with us. When we return, we'll get into how it's affecting the life and the living conditions of the everyday Ghanaian. Stay tuned. You're still watching Business Edge. Ghana ends 2025 as the 4th in Africa's IMF debt ranking, but of course it addresses some of the short-term issues, and the numbers are looking good. The numbers coming out of Ghana when it comes to inflation, the currency itself, are looking much better. We do have Patrick joining us, Patrick Baah Abankwa, who joins us and he has provided quite some insight on the conversation. But let's come now to households and businesses who are living through higher taxes, subsidy cuts, tighter credits, and I promise the benefits somewhat of IMF-backed reforms. Are they becoming visible? How are they weathering this period?
A bit of a disconnect with the numbers that you rightly said and its impact on the household and businesses. I think that macro stability, which is what we, the economists, always look out for, often takes time to become micro in nature in terms of how the people feel. I think that the benefit right now is that it's actually what didn't happen. If you look at it from the broader perspective, what didn't happen is the fact that the cedi has not depreciated as we saw in 2022-2023, where we saw the cedi depreciated against the dollar around 54% for the year. At the moment, we still have our cedi to the dollar around 11 cedis or 12 cedis, which is way better than what we saw where the cedi rose up to about 17%. So it means that we have prevented something bad from what we are experiencing now from happening. So you look at it from that point to say that that is a very good step. However, as you rightly said, for the ordinary household, the businessman, stability should not just mean that prices did not go up, but the fact that the prices are going up, but they are not rising as fast as we used to see. And that doesn't mean that prices have gone down. It only means that the rate of inflation has dropped. The cost of living is still very high in Ghana. And until businesses get to the point where they start to high again because of low credit facility, the average Ghanaian won't feel the success of this particular program. So for me, it is still work in progress in terms of the benefits. If we're able to sustain the gains that we have seen in 2025 into 2026, then I'm sure with time we'll begin to see or feel the benefit as ordinary household, and also businesses will begin to see the impact, because as you speak, credit facilities or lending rates from the beginning of the year, which was around 32%, 36%, have dropped all the way to around 22, 21 now. It means that if that continues, credit will become a bit cheaper in the country, and that will mean that businesses will have much money to expand, and households will also be able to buy things at lower prices as compared to what we experienced some 2 or 3 years ago.
So it's some sort of lag effect, and if we're able to sustain the gains, it will touch the ordinary people of Ghana. Now, yes, the IMF program, it said that exiting an IMF program is often as delicate as entering one. So what risks does Ghana face if it struggles to exit on schedule? And what dangers arise if it exits before the economy is truly ready?
Thank you very much. I think this is one of the critical questions around the IMF program. And it's always very important that you look at the time that you go in and the time that you go out. And that's where we look at the exit and the entry. If we try to move out of the program quickly without cementing our fiscal rules, which in this case, I'm looking at the risks of fiscal relapse, we are likely to go into the space where we spend recklessly in the next cycle, especially if you look at our election coming up in 2028, and that can lead to the cedi crashing. If we stay in too slowly and we rely on the IMF program forever, then we risk what we call the reform fatigue, where the private sector would now be suffocated under tight taxes and growth status. So the sweet spot for me is that we are exiting only when our domestic revenue can fully cover our bills without external validation. That's for me the key point. If we get to the point where you have enough domestic revenue, we have tax base widening, and we have so much to cover our yearly and annual budget, then at that point we can say that, okay, we have gotten to the point where we don't need external credit facility to be able to validate what we can do as a country. That is the point that we can peacefully exit this program and not have the issue of fiscal relapse or reform fatigue that comes with either exiting early or staying too long as a program.
So a lot of this is hinged on stronger domestic revenues. From what you're seeing, is revenue mobilization improving fast enough to meaningfully alter Ghana's debt trajectory?
From where I sit, I would say that there are a bit of green spots that we are seeing at the moment, giving some indications of what can happen in the future. Especially if you look at the way we have been able to digitalize our tax system and recent move by government to formalize the gold sector, that gives an indication of the step that government has taken and its impact that we are seeing as a country. However, we are still underperforming compared to our potential. If you look at our tax to GDP ratio, it's quite improving, but it's still not at the tipping point that we are expecting between 18 to 20%, which is needed for us to be self-sufficient. So I would say that we are still relying on the credit facility, which is the external support, because our tax revenue is still not there yet. But if we continue with this particular process and we don't allow pressure within the country to overtake what government is doing, then I'm sure with time, give ourselves 2 to 3 years, we should be able to get to the point where domestic revenue mobilization is able to cover the shortfall that we always have in our budget.
Okay, we'll be tracking to see whether or not that is achieved within the country. But thank you so much for your time and perspective, Patrick Baah Abankwa, international financial analyst and investment consultant.
My pleasure.